Happy Friday. Here's what's shaping mortgage rates this week. The BLS jobs report was the big one, and it came in all right, but previous months getting revised higher hurt us, and so basically the report made the labor market look stronger than it really is. Unemployment did dip slightly, but that's likely due to population adjustments, not real job growth. The market again could see this as strength that's not really there, and wages were up, which could fuel inflation because the expectation is that more earnings leads to more spending, and if you're wanting rates to come down, you're rooting for a cooling economy. And the job numbers are still skewed, and that's just due to the way the data is gathered, and we expect future revisions to show more weakness, but unfortunately the market really reacts to the headlines. And I'm sure you've seen news of the US using tariffs as a negotiating tool with Canada, Mexico, as well as China. And while Mexico and Canada have basically made concessions, China is really holding firm, which could again lead to inflation, which is not good for us. And there's also talk of tariffs on the European Union, and that could increase the cost of goods as well. The bond market has been a little nervous about how Trump's tax cuts and spending policies are going to impact government debt. And if the U.S. has to issue more long-term debt instead of short-term debt, it could push mortgage rates higher, but the good news is the Treasury Secretary is focusing on issuing more short-term government debt instead of long-term debt, and this strategy could basically help lower long-term interest rates, which is good news for mortgage rates. And meanwhile, the Fed did hold rates steady, and they aren't in a rush to cut rates. The next big market mover is going to be next week's CPI inflation report, and if inflation comes in lower, we could see rates improve, and some experts are expecting that to be the case. Good news there. Job openings are finally seeing a bit of a decline, which could help mortgage rates in the long run. It's kind of weird to hope for a slowing economy and higher unemployment, but that's what it's going to take to see lower mortgage rates. Next week's CPI again and retail sales numbers will be key, but if inflation does continue to cool off, then we could see mortgage rates trend lower. But if it stays sticky, you can expect the Fed to basically hold rates higher for longer. And the labor market is not as strong as it looks, but inflation numbers next week are going to be big, and I'm hoping that the Treasury's strategy might help bring down rates over time. Have a great weekend, and I'll see you next Friday.